You hear this number all the time, right? The U.S. national debt, something like $30 trillion. I mean, that's a number so big, it's kind of hard to even wrap your head around. And it brings up a really important question for all of us. At what point does all this borrowing become, actually dangerous? Okay, let's get into it.
So, is it a ticking time bomb? A lot of us have that image in our minds, right? That's just waiting to blow up. But is that really the best way to look at it? We're going to unpack the real economics behind it, the actual risks, and figure out what truly matters when we talk about the national debt. All right, so before we can even get into the heavy stuff, we got to make sure we're all on the same page. There are two words that get thrown around all the time, often interchangeably, but they mean totally different things. I'm talking about debt and deficit. Think of it like filling a bathtub. A budget deficit is how much water you're adding in a single year. It's the flow from the faucet. Now, the national debt, that's the total amount of water that's already in the tub from all the years before. It's the stock. So, pretty simple, right? Every year we run a deficit, we're just adding more water to that big old tub of debt.
Now, here's a really crucial point. To get a real handle on the debt, economists don't just stare at that giant raw number. That wouldn't tell you the whole story. Instead, they measure it against the size of the entire U.S. economy, the GDP. And this debt-to-GDP ratio, that's what gives us real context. You can see right here how it shot up during huge events like World War II and again in 2020. But what happens after these spikes? Well, that's just as important.
And that brings us right to the heart of the matter. If that debt-to-GDP ratio is the number to watch, is there a specific point, a tipping point where things really start to go south?
Yeah, this is the big one, isn't it? Is there some kind of magic number where good debt turns into bad debt? Well, researchers at the World Bank actually tried to answer that very question. They dug into the data to see if there was a real identifiable threshold where debt starts to put the brakes on economic growth.
And they found one. After combing through data from over 100 countries for almost 30 years, their study pointed to a clear tipping point for public debt. And that number is 77% of GDP.
So what does that 77% actually mean? What happens when a country crosses that line? Well, according to the study, for every single percentage point of debt you go above that 77%, economic growth slows down just a little bit. It's not like falling off a cliff, it's more of a gradual drag. And what's interesting is for emerging markets, that tipping point is even lower, down at 64%, and the drag on their growth is a little bit stronger.
Okay, but hold on. That 77% figure doesn't mean it's an automatic disaster. It's not that simple. To really understand the risk, you have to get your head around a key idea. A government's debt is fundamentally totally different from the kind of debt you or I have, like a mortgage or a credit card bill.
Yeah, the differences are huge. I mean, think about it. We have to pay off our debts within our lifetime, right? But governments can just roll over their debt by issuing new bonds to pay off the old ones. They don't have a lifespan. Plus, a huge chunk of the U.S. debt is money the government owes to itself or to its own citizens. And maybe the biggest difference of all, the U.S. government gets to pay its debts in a currency it can literally print, the U.S. dollar.
Now, that's not me saying there are no downsides. Come on, of course there are, and they're very real. For one, the more debt you have, the more of your national budget gets eaten up by interest payments. That's money that can't go to other things. It can also make inequality worse, because the people who own government bonds are often already wealthy. And yes, it absolutely creates a burden for future generations who have to keep making those interest payments.
This whole idea of who's burdened by the debt, it leads us to another really important piece of the puzzle. Who actually owns all these U.S. government bonds? Who are we in debt to?
And the answer might actually surprise you. Take a look at this.
Over a third of the debt is held by the Federal Reserve and other government accounts like Social Security. So, in a way, the government owes itself. And when you add in all the American individuals, businesses, and pension funds, you realize the vast majority of U.S. debt is actually owned right here at home. Okay, so if the sheer size of the debt isn't the automatic trigger for a crisis, and the tipping point is more of a gradual drag, then what is? What could actually cause a meltdown? Well, the answer seems to have less to do with the amount of debt and a lot more to do with behavior. Listen to how the experts at the Brookings Institution put it. They say a fiscal crisis isn't about hitting some random number. No, it's a crisis of confidence. It's what happens when investors all of a sudden lose their appetite for U.S. Treasury bonds, the very same bonds that have always been seen as the safest investment on the entire planet. And you know where a crisis of confidence like that often starts? Politics. Think about those high-stakes political battles over things like the debt ceiling. That stuff creates doubt.
Not doubt about whether America can pay its bills, but whether it's willing to. And that tiny seed of doubt, that's all it takes to spark investor panic. If the U.S. ever loses that rock-solid credibility, it would suddenly have to offer way, way higher interest rates to get people to buy its bonds. And boom, a political fight turns into a real, full-blown economic crisis.
So after looking at all this, the data, the expert opinions, how it all works, we end up at a really powerful conclusion. The ultimate danger here, it's not about the debt-to-GDP ratio creeping past some invisible line. It's about losing the single most valuable economic asset the United States has, and that is the full faith and credit of the government. It's the absolute, rock-solid trust that the U.S. will always honor its obligations. Always.
So that leaves us with a final, really important question to chew on. Is the real threat the debt itself? Or is it our politics? Is it the number? Or is it the kind of political behavior that can make the rest of the world start to question our willingness to pay? That, I think, is the real question.